When I first started, I spent a lot of time charting and analyzing stocks in all kinds of ways. It was exciting, tons of fun, but ultimately unprofitable. I kept at it until I was 19, devouring every book on investing at the public library. I was fascinated but lacked any real framework. I hoped charts would somehow reveal what a stock would do next. It was kind of wild, but everyone else was doing it, so I followed suit. Sometimes I'd even turn charts upside down to see if that helped. It didn't. Then in 1949, everything changed. I discovered The Intelligent Investor by Benjamin Graham. I had never heard of him before. That book gave me the solid foundation I was missing. While only 2 chapters are truly essential, they reshaped how I think about investing in 3 profound ways. The first key idea: a stock is not just a ticker symbol, it's ownership in a real business. You can't evaluate a stock without understanding the business behind it. What does the business do? How does it compete? Who's running it? When I was younger, I could recite all the ticker symbols on the New York Stock Exchange, but I didn't understand the companies behind them. That had to change. I needed to start seeing stocks as businesses and learn to value them accordingly. The second concept was Graham's brilliant metaphor of Mr. Market from Chapter 8. It taught me how an investor should respond to market volatility. Mr. Market is like a business partner who shows up every day offering to buy your share or sell you more at different prices. But he's not always rational. In fact, he's manic-depressive. Sometimes he's euphoric, other times he's gloomy or drunk. The key is, you don't have to engage with him unless the deal favors you. The market exists to serve you, not instruct you. Ignore it when it's unhelpful, and only act when the odds are clearly in your favor. Think about how absurd the stock market is. You can find sound American companies whose shares fluctuate by 2x within a single year. Compare that to real estate, land, or apartment prices don't behave that way. Yet with stocks, those price swings are just noise unless you know how to take advantage of them. The third big idea was the margin of safety. If a bridge says it can handle 10,000 pounds, you don't drive a 9,800-pound truck across it, you find another bridge. In investing, the same rule applies. You want a buffer. You wait for opportunities where the value is so compelling it practically jumps out at you. That's the margin of safety in action. These 3 principles, stocks as businesses, the irrational Mr. Market, and the margin of safety, form the bedrock of sound investing. You can build any strategy on top of them. Remove one and the whole structure wobbles. Now let's say you're given a large sum of money and told to invest in any 3 businesses in Tennessee within a week. What would you do? You'd study each business carefully, looking for those with enduring competitive advantages, ones that can survive and thrive despite competition. You don't want a business that's doing well just because no one else has moved in yet. You want a company with a moat, something that protects its profits over time. A moat can come from many things: patents, superior branding, prime location, or customer loyalty. Take Coca-Cola, for example. 6 billion people recognize the name, and most associate it with positive experiences. That's powerful. RC Cola could spend $1 billion on ads and never come close to Coke's emotional connection. Besides the moat, you want a company run by honest and competent people. In fact, the best businesses are so strong that they can even survive a mediocre manager. Peter Lynch once said, "Buy a business so good that an idiot can run it, because eventually one will." There's some truth to that. And finally, you need a reasonable price. You don't want to overpay, even for a great business. A key part of this process is knowing what not to waste time on. That's a skill in itself, being able to quickly eliminate poor opportunities. I once read a New Yorker article about how chess masters narrow down billions of possible moves to just a handful of good ones. Investing is the same. The best investors know how to filter out the noise. If someone told me to pick the 10 best performing stocks from the Dow, I'd start by identifying the worst. Eliminate what doesn't make sense, and what's left becomes more valuable. That's often easier than trying to find winners from scratch. So when you look at the stock market with 3,000 plus companies and prices, changing every day, remember, you don't have to play every game. Just find the few great opportunities, maybe only a handful in your lifetime, and make them count. In fact, I sometimes tell students they'd be better off if they had a punch card with only 20 slots for investment decisions. That way, they'd really think before using one. At Berkshire, we don't bother with small plays. We focus on decisions that move the needle, because great investments are rare, but they're enough to make you very rich if you choose wisely.